Okay, let's start the session then. Good afternoon and welcome to the webinar. I don't know how many people are in the room right now, but I guess we are a small group today. Let me start by pulling off a picture here. What you are seeing right now is are both trading platforms we are using right now, and I'd like to start off with something that's apparently a bit boring, but it will be an interesting starting point. Allow me to ask you a question before we delve into the topic of leverage. And that is, I would like to ask you if you trade by any particular risk-reward ratio, if this is something that you pay attention to, and if yes, what is the relationship you are using between the risk and the rewards in your trades? That is the size of the amount risked in each trade to the amount of potential profits, that so-called risk to reward relationship. Do you have any preset? Yeah, risk 1, target 3 at least. Okay. Is there any other input regarding the risk reward? Okay, I'm asking you this because this was one of the starting points a few years back when I started developing this trading approach, or at least adopting a trading approach, which obviously I was under influences by other people who were already taking trading to a level where it was more about money management than strategy itself. And previously to starting our track record, which started more or less by spring 2015, I did a series of tests, of preliminary tests to validate some of the hypotheses. And one of the first tests is the one you are seeing here on screen. And this particularly was an exercise I had to do in an educational program under Dirk Dutoit back in 2014, I believe it was. And we were expected to generate dozens of trades in a random mode, so to say, and apply to them some fixed targets and some fixed stops, and in different relationships, and to quantify the results, how many trades hit the target or the stop before the other. And interesting here is where you see my cursor. We had this risk to reward relationship for different targets, different thresholds here of 30 pips, 50 pips, 100, 200, and 400 pips, and different risk to reward relationships, 1 to 1, 3 to 1, 1 to 3, and 1 to 4. And interestingly here was that when the conventional approach, which is to risk much less than targeting in a 1 to 3 common relationship, when that is inverted to a 3 to 1, that is when I risk 3 times more than I aim to get from the market, then you see how for all the different targets of 30 pips to 400 pips, the percentage of trades hitting the target increased substantially compared to the 1 to 3, which was stuck in the 30%, 38 in this case. But when inverted to 3 to 1, immediately the success rate jumped to over 60%, 70%, even more than 70%. We can compare this to the 1-to-1 relationship, which hovers all the time around 50, barely 60% here. So we can say we stayed within the randomness, which was part of the exercise. And when we increase this ratio even to 1 to 4, then we go even further below in the let's say in the amount of times that the stop is hit. Okay, so this brought into the picture something that, well, was quite conventional thinking at that time, which was to risk less than that what you want to achieve in a market. And this was one of the starting points to try to formulate the possibility to work with much larger stops than targets. Nowadays, if you have observed the track record which we have been accumulating, we have no use of stops per trade. That is, what I'm doing here is I manage the entire position understood as the amount of trades taken in one direction. So there is a short position, a long position, and it gives way to a floating amount, which is the balance minus plus the open trade, and that is the amount that I'll be focusing on and trying to manage those both legs, short and long. Let me go here to the track record. So let's see. What we saw here are two platforms. These are two platforms. We have here on the right, this is CTrader. This is the corporate account, which we started a month ago, a little over 1 month. And on the left side is a Wanda platform, FX Trade, and this is the one which has the large track record, starting in 2015. And here we are tracking the new account. Okay, we are tracking both. They are both accessible through. If you want to follow us, we have, by the way, I will post here the link for you. Okay, here's where you can follow the trades in real time through these widgets, and also part of the tactics or reasoning or strategy that I'm adopting on an intraday basis. This is updated several times a day, and then a few tools that I use to find the setups and to calibrate the exposure, and here you have the statistics for the other account. I must say that the the previous account is divided in two because there is the long leg and the short leg. So to circumvent first in, first out rules imposed in the US, that is something that we don't have here with CTrader FX Pro. We are able to hedge everything in one same account. And as you see here, we have the balance curve and the equity in yellow, which is floating below and above the balance curve. This is typical of a track record that is shorter in time. We have just started in the 18th of January, so slightly above 1 month trading. And the typical development for this kind of systems is to have the equity curve deviating from the balance curve as soon as the pair that you are trading or the markets that you are trading break out from the current range where you started trading and explore new price areas. And by moving away from that range where you started trading, there are some trades which are floating in negative, which you go deeper into the red. And the aim with this system is to manage that floating position, so that you don't need a stop loss per trade, so to say, but instead what you are measuring is the exposure in one or the other leg, as to maintain the drawdown as controlled as possible. Okay. Until now, so far, is everything understood? I would rather prefer that you have any inquiries or inputs or doubts. This is something that I've been doing for a long time. So if I'm jumping too fast here, just advise me, and we go back to cover all doubts. There are many aspects to the system that we will be covering in these premium sessions. So not everything will be covered today, but at least I would like for you to go from this session with an idea of what is possible to do when operating in such a manner, where you do not make use of stops, but instead you manage the leverage or the margin, so to say. So far, any questions? Okay. Let's see. One of the starting points was, as I told you, was the one was this hypothesis of inverting the risk-reward relationship. Yeah. Okay. Thanks, Pat. Thanks. All clear. Okay. Fine. And another starting point was the fact that I wanted to, let's say, adopt part of the randomness, which is part of the price price structure or price movements, and adopt part of that randomness into the system. Usually, if you have a conventional approach to go in and out of markets, trade by trade, then obviously not only you have statistically the odds against you if you are trading with a conventional risk-reward relationship, but you need really a very high skill set in order not to be affected by neither by randomness, neither by perhaps more complex variables which can affect your trading, which are not all pertaining to markets per se, but also personal issues. You may encounter situations where you lose opportunities, where you make errors, and all these, if your trading is highly dependent on the winning rate of, or the consecutive winning rates of all in, all out, or one by one trade strategy, then you really need, as I said, a very developed skill in the market. And then you need also a very good timing element into it. And the timing element, by timing, I'm referring not only a tool which you can use to time the market, to fine-tune your entries and exits in terms not only of price but also in time, but also timing in relationship to your own behavior. Okay, you may, as I said, you may lose an opportunity. You may move a stop loss against your rules. You may over leverage for overconfidence, etc., etc. Unless you have this this aspect of under very strict control, and you are very experienced in these in these aspects, then the timing element is something that you may wish to not to use in your trading. And this was the another reason why developing this kind of strategy. That is, I wanted to profit from something that was particular to price behavior in the FX market, which is this randomness that is built in price developments across the all time frames. Yeah. And I come up on studies which measured this kind of volatility. Yes, we may have different measures of volatility, as you know. We may have volatility, for example, when you measure what is the range between one point in price and time and another one. You may measure the range. Yes, not considering what happened in between, or you may measure from the same starting point to the other, the entire range, okay, from between highs and lows. This is another practical measure of volatility. You may measure volatility in terms of some average, some like an average true range, for instance, where you average all the ranges from a number of periods. Yes, but then I found that there is another way to measure volatility in practical terms, which is to measure the movements, the particular oscillations in the price structure, yeah, and to come up with a number that is different in quality than the previous ones. When we talk about volatility in traditional sense, it is usually related to risk. I want to measure volatility in order to quantify the risk that I have. And another practical way to measure volatility in terms of the sum of these smaller up and down movements of these thresholds in the price gave me an information not about the risk in the market, but about the potential. Yeah. If I take, for instance, this kind of approach, okay, and let's say I measure on a daily chart we have here with a big D. I measure the price movement on a daily chart. Okay, we have an up candle and two down candles. I may measure how much it moved up, how much it moved down, and come up with a figure. Okay, but if I go down into a smaller time frame, let's say 4 hour, I can measure. I can start measuring the ups and downs in the different candles and come up with a larger figure. Yes, because I have more detail. And as I go down, as I dip into smaller time frames, then the number of oscillations or the thresholds to measure these up and down waves will increase the amount of pips, will increase the volatility figure that I'm trying to quantify. And by that, I come with a figure for the potential that a market can offer me, yes, in terms or in the relationship to the typical average, which is providing me a figure of risk. Okay, if I transform a daily chart into a 1 minute chart, for example, I see that the line made up of these up and down moves, yeah, if I were to put this line flat, then I would come up with a much larger distance than the line formed by the daily candles, right? We are talking about the same measure between the high and low that would have stayed the same, but the length of movement become much larger. Okay, and I thought in the beginning, is there a way that I can profit from all these up and downs, many of which may have a technical explanation in hindsight, but are so difficult to time, so difficult to forecast on an intraday basis that I may use another approach in order to capitalize on them, in order to capture most of these movements. Okay, and this established the hypothesis to develop the system that I'm about to explain. Yeah. In other terms, we can. This is similar to, in graphical terms, this is similar to a point-and-figure chart construction. Here we have taken from Reuters icon. This is a point-and-figure chart constructed, and here you see that each. I don't know if you are familiar with point-and-figure, but point-and-figure charts for each box containing an X or an O. You set up the chart knowing what is the amount of pips that in this case the market has to move in order for the chart to print to print an X or an O, depending on the direction of the movement. Okay, and if you choose, like we have done here, a threshold of 50 pip, okay, a 50 pip threshold, that means each time the price printed an X or an O, it means the price moved by 50 pip without retracing 50 pip, okay, or more than 50 pip, okay. And here I came up with a measure, yeah, similar to the one I was explaining in the previous charts, yes, of 5,200 pips, yeah, moved or walked through, yeah, in a range between high and low of 650 pip, okay, or a different a relationship of 8 times the potential compared to the risk. Okay, 8 times the potential compared to the risk in terms of conventional volatility measures. Okay. So this is to say, and I guess at this point you may be asking, what is the strategy in itself? What does the strategy capitalizes on how do I enter or exit the market? And this is a very legitimate question, but let me tell you that this is not the strong point in this approach. I would add to it that if you have right now a trading approach that you are using, and you are having some difficulties in balancing the statistics in terms of win rate, or the win rate, or the profit factor, or the drawdown or drawdown recoveries. If you are struggling in finding the balance between all these stats, and your system is not providing the results you wish to, you may adopt that same strategy in terms of entering and exiting the market, and transform it by using a different type of money management, yeah, where you dump or increase the stop sizes a lot, yeah, you inverse, and you inverse that risk to reward relationship from 3 to 1 to 1 to 3, or vice versa. And in terms of what I mean is, you increase the ratio so that you are risking much more than you are going after in terms of tips, so that you allow the markets in its typical oscillations to hit the targets much more often. Okay, and by hitting the target much more often, what are you doing? You are accumulating balance. You are accumulating balance, and the balance which you accumulate over time is the one which will provide you a cushion to sustain the possible drawdown that you are going to experience. And by the way, we are mentioning here drawdown. By drawdown, under such approach, it is not understood the typical drawdown figure, which is a series of losses, yes, or the maximum drawdown, the maximum series of losses attained historically in the trading performance. But instead, by drawdown, under such an approach, the drawdown is the floating position. The drawdown is something you are going to live with. Drawdown means those trades that are still open and probably in the red, probably losing, yeah, which you are monitoring, which you are compensating with a lot of smaller positions which you are closing every day, yeah, and which you eventually will manage by closing positions in the loss, hedging positions between both legs, yeah, or compensating with a floating trade or position which is in the positive. Okay, there are these possibilities. We will go into future sessions more on the particulars of the management of the floating position. But what I want you to understand here is that the drawdown in such an approach is not the conventional drawdown figure, which you have to recover from if you experience such a drawdown. Okay, we know the figures to how much it costs to recover from a drawdown. In order to recover from a 50% drawdown, you have to make 100% return, right? To be break even once again. Okay, in this approach, we are not talking of a drawdown that has to be recovered as such, but it's a drawdown that is probably going to be there always. Yes, and the point is that you may have a drawdown of 50%, let's say, which in other systems would be practically in practical terms very difficult to recover, because it would mean you have to make 100% return to recover from a 50% loss. But in this case, the point is that you can have a 50% drawdown, yes, floating drawdown, if you already made 100% or 200% in your balance, right? Then you are still making profit. If you close all trades at a certain point, you are in positive, despite of the drawdown. Okay, because you are closing a lot of positions. I have to say here something that you probably don't know is that the success rate of this type of approaches is very high, obviously, because you give price the room to achieve the targets. Yeah. In my case, I even don't work with a risk-reward relationship because I do not use stop loss orders as such. Yeah. So really, each trade has a lot of time to go and to reach its target. I may be closing positions now, which I opened 12 months back, for example. Yeah, and I may close them in for 30 pip a profit when they have been 500 pip in negative or 800 pip in negative. Yeah. Okay, it's a terrible risk to reward relationship if we see that way. Okay, but the win rate is extremely high. Yeah, you see here by 94%. Okay, we just have here a short period of trading of 1 month, but if we go to the larger one here, we see the 94, the same one in a track record of 2 years, 94%. Okay, and that's about it. I haven't moved from this figure in all this time, 94% win rate. Okay. So if through randomness you are sure that you are closing well above 90% of your positions, okay, you want to profit from that. You want to capitalize on that. You want to trade intensively, yeah, in order to make a lot of pips. Yeah, this month in this account will be 458 pip, and that account this month almost 1,000 pip in 1 month. Okay, this is maybe, or I would not say exclusively, because there are all sorts of trading strategies, and they have to fit a certain character, obviously. You, but there are not many strategies which attain such a high level of tips on a day-to-day basis, which is, by the way, a psychological effect. One that I soon found to be very beneficial, the fact that you are closing a lot of trades, small ones, but in terms of pips, it's always a high number. This gives you a certain satisfaction to be in the market. And besides, you are always trading. There is not the sense of losing opportunity, because you are always in a market with lots of trades. You are always closing positions almost every day. And if it happens that you want to trade right now, if let's say, I would like to sell this market here, I can come here, create new order, I check if everything is okay, I put a stop, I put a take profit 50 pips, and I sell the market. And I just enter a position. I'm not considering so much the technicals in this aspect. I usually do, but I know that this position, which I just entered, it has a very high possibility of hitting the target. Yeah. Obviously, I will not trade this way, like I did just now, opening a trade without a technical reason. But I may, if I wish to, I may. So you will experience this beneficial thing of, if you want to trade, just open the platform, enter a trade, and you know that there is a high probability that this trade will be closed in profit. And if not, you will be able to manage, because it is so small compared to the leverage you are trading per trade. Is so small. It's infra leverage that it will not cause any harm if this position goes into loss for the next 12 months. It will be not this single position that will kill your account. Okay. So far, are there any questions, any inputs? We covered a lot of elements here of the system. Oh, okay. Yeah. Is there anyone using this kind of approach in terms of money management, like that is to monitor the entire position instead of monitoring the trade by trade? Any experience with that, or have you ever encountered some traders who might operate this way, or do you have any preconceptions about what kind of system or methodology this should be? Any ideas regarding this? Okay, no problem. Yeah, learning. It's why I'm here with you, and hopefully for many more sessions. See, we have here, basically this is all done in euro-dollar. Okay, what you have seen. We have another corporate account where we trade several pairs, but for now, what we are seeing here is just euro-dollar. And you can see the errors here on the CTrader platform. You can see the errors signaling the open and closing of positions. Yeah, at least the most recent ones. Okay. Yeah, I think we have. Yeah, this is about 18th of January when we started. So you see, a little bit of zoom. You see, there are trades which are very, very small. Yeah, trades which are very small, either in time duration, like this one, or small in price, but large in time. You see this one, this trade entered here. It was closed here for profit. I think it was this one here. It was closed for profit for, I don't know, maybe 20 pips or 10 pips or something between 10 and 20 probably. Yeah, and see the huge loss this trade was incurring in between. Yeah. Okay. So this is the point. Obviously, you want to combine this kind of approach by becoming better and better and more skilled in your technical approach as to enter and exit the markets at critical points, so that you can really accumulate a lot of points in order to make the balance curve grow and compensate thereby the floating loss. Yeah. Right now our floating loss is little. Yeah. This was seen here. We have the yellow curve slightly below the balance. Yeah. But it can go deeper, like it did here. It can go much deeper than the balance. Yeah. And if we see it here, where we have accumulated, I don't know, many trades, 420 trades, we see how it can deviate. It can go really far from it. But I have to say, in this case, whereas you are seeing here an account which has both long and short positions in it, here you are seeing only an account which is comprised only of short positions. Okay, so probably at this time, where the equity curve for the short account was very deep, below the balance, probably in the long account was the inverse situation. Yeah, so I was compensating the loss here, the floating loss here, with some positive equity on the other position, on the long position. Okay, and there is really no fixed take profit. Yeah. Usually what I do is I look for price levels where I can think of liquidity being available, or big imbalances in the supply-demand equation, so that it makes a high probability trade on that spot. I use a lot of technical confluences. I try to I use very basic technical setups as channels and Fibonacci's and averages. And the key here is, when you have a confluence of technical levels in one same price range, then it's probably going to have a reaction there. And all these small reactions on an intraday basis are opportunities to make points. Yeah, if I can make 5 points here, 10 here, 20 there, okay, then I can accumulate balance, and by accumulating balance, I can have a larger floating drawdown. Okay. By the way, this system, in the configuration that I use currently, with the leverage that I'm using here, yeah, which is I've reached the maximum of effective leverage of 50 to 1. Usually I'm about 10 to 1 leverage. Okay. The amount of pips, this system aims to collect is about 28,000 pip. By 28,000 pip, I'll be in a position where I can sustain a 60% drawdown and still be break-even. Okay, right now we are about 80,000, 80,000 pip, okay, or almost reaching there. And by 28,000 pip, the balance curve has grown so far that I could sustain a drawdown of 60%. The maximum drawdown or floating drawdown that I've incurred until now in these almost 2 years of trading was about 32%, more or less. Okay? But I can double that and still be break even if I reach to accumulate 20,000 pips. Okay? You can make the numbers. If you obviously if there is higher leverage, you make more in percentage terms. The factors are several, among which you can play with. The number of trades, the thresholds, and so on and so on. You may also obviously close positions more often than I do. So there are really many aspects which you can personalize in such an approach. But the idea is to accumulate an amount of pips to allow to be break even if you have a large drawdown. Okay, that is the idea. Okay, and we will talk in future sessions about how to manage that drawdown. You know, how to control that floating position, because this is done at one side. This is by managing the capital, managing the position size, and managing the hedge, the hedging in the system. And on another hand, there is also a certain degree of tactical considerations, in my case of technical nature, which give way to take out the hedge or to increase the hedge at certain moments, depending on the price structure and on the price action. Okay, so I want to profit from price movements. I want to profit from trends. I don't want to be 100% hedged all the time, and therefore it's useful to analyze the charts and to have an idea of where prices could go and make a plan in terms of not only opening and closing positions, but also in terms of or opening and closing trades, but also in terms of managing the positions, the entire positions. Okay. Fine. I think we are reaching here our time. We have perhaps a few minutes left, but I believe that we covered a lot of things to be the first time. Hopefully you got an idea of what is possible to do in the trading world by thinking a little bit out of the box and in unconventional terms in respect to the use of stop losses, in respect to the typical risk-reward relationships in trades, and what to do about the randomness, how to profit from it, and how to deal with the fact that we do not have precise timing tools, most of us. Obviously, there are timing tools. There are timing techniques. But if it is not part of our arsenal, then why to try to time the market? when we can't do it by a use of an oscillator or a moving average. I mean, we can have a statistical approach to it. Obviously, we can calculate. You know, I believe this is the CCI, or well, not sure here, but you can measure the deviation from price to a moving average and reach historical extremes and say, well, price has deviated from its 200 moving average by so and so much. And this is a probability of price returning to the mean, and so on and so on. But it's not really a timing tool. Timing tools we have when it comes to cycle theories, when it comes to GAN, when it comes to astrology, finance astrology, and so on. There we are talking about powerful timing tools. But unless you are a master of timing techniques, you better look for an approach where you free yourself of having to time the market. Yeah. And this is one approach, one possible approach. Okay, thanks for your participation. If they're welcome, Adam. If there is any other question, we still have a couple of minutes. If not, then yeah, for sure, we'll meet here next time. We'll be making these kind of sessions something more regular, so that you become more familiarized with this kind of approach. Do not forget, you can follow up the trading at fx3.com/trading. You have the statistical the positions in real time on that page, and also on a daily basis you have my inputs as to what I'm looking after, or some recommendations as to what to read, what to look for at fx3.com, and this hopefully will enhance your trading abilities. Okay, thank you very much, and see you soon. Bye bye.